Thank you very much for clicking. We're going to be talking about interfamily loans today. And Tim, one of the things that I've always heard it said is, just say no. Not just say no to drugs. It's like, we don't need to be loaning money around the family, because oftentimes, isn't it the case that people who get the loan think it's really a gift?
So I'm going to ask you to suspend judgment for just a couple of minutes, right? Certainly the bank of mom and dad or the bank of a rich uncle can have a negative connotation.
Yes.
But I've actually seen it be mutually beneficial.
Okay.
And it can work, and we'll talk about some of the maybe do's and don'ts,
Sure.
how to make it work.
Well, let's start there then. Okay, if it works, and often it can, if it's done properly, how do you see to it that it works properly?
Yeah, so a couple things I think are important. One, that we want to make sure that the agreement is known that this is a loan, this isn't a gift, right? And many times that includes a simple one-page, you call it a promissory note, just something that says, hey, I loaned you this money, you've agreed to pay me back in this manner. And I'd go one more step that is critical. Have the payments be automated to your account. So I loan you $50,000, you promise to pay me $1,000 a month. I don't want to chase you every month. I want you to set up a direct deposit into my bank account each and every month, and it's just known that it's expected to be paid back.
And what happens if it doesn't? In other words, even if you do the automatic payment, say they're overdrawn, the payment doesn't come, then what?
Yeah, you have a difficult decision, certainly. I mean, are you really going to sue this person that is maybe a child or a relative? Most likely not, and that's why I don't suggest a lengthy or a formal agreement, because if you're not going to actually go to court with this agreement, it's for naught. But let me give you a good example.
Okay.
I have a client whose son needed a vehicle, graduated from college, first job, bought a vehicle for $40,000, and rates were about 7%. Well, mom and dad, instead of having son go pay 7%, loaned the money to the child at 4.5%, right? It's a win-win. Mom and dad had money that was only earning about 4% in the bank. They get 4.5%, and son gets a much lower rate. That's a win-win.
And that's one of those things that your planner is going to be able to do for you, right? In other words, help you become your own banker, in essence. They can spot that and say, hey, let's try this.
Yeah, absolutely. It's just another option, and especially between family members. And I say mom and dad and kids, it certainly can work out. We have clients where mom and dad actually own the mortgage. Again, mom and dad get 4 or 5% in interest. The kids are saving interest payments, right? There's no upfront cost like a traditional mortgage, and everything can work out as long as both parties realize this is a loan, not a gift.
And so that's the thing, when these ideas come up, that you take that to your financial planner and say, this is what we're thinking, what do you think? And then they can help guide you to make the kind of decisions and make the kind of plan you need to execute. Thanks for watching.